And welcome to the Mutual Fund Show. I'm Neeraj Shah, and over the next 20 odd minutes, we'll try and talk about, if you're confused about what kind of portfolio you need to make during markets which are bullish or bull markets, and should the portfolio change meaningfully during arguably bear markets, and if you believe you're not equipped enough to take that call, then can you do something about it? Well, Birla Sun Life AMC has a term that they apparently have coined for it, which is pro investing, a pro portfolio. Let's get in Mr. A. Balasubramanian to talk about, forget the nomenclature, but the whole concept that goes behind trying to build an all-weather portfolio. Mr. Balasubramanian, great having you. It's been a while. Thanks for joining in.
Yeah, thanks, Neeraj. It's been, as you rightly said, has been quite a while and I've been part of your show. And thanks for having me part of the show today.
No, the pleasure is ours. So tell us, is it even possible to conceive a portfolio which can kind of be an all-weather portfolio?
So I think the way I think we came with the concept of pro investing. I think if you look at the historical way of driving the education, awareness, and promoting mutual funds, since I've also been driving it as part of the AMFI as a mutual fund SAI at this point we used to do. The SAP way of investing was the right way of investing. That's something we created a huge amount of impact. I think we had Aditya and AMC also have been doing that and promoting SAP way of investing for large investors. So that remains. Second, of course, is the bigger challenge for every investor is actually investing in equity market or creating a portfolio that could help in creating a longer term wealth. And what most of the time the question that comes in the minds of people, how do I go about creating a core portfolio? I think core portfolio is something essential in everyone's portfolio to create a longer term wealth. At the same time, you end up having a confusion in terms of the variety of mutual funds schemes are there. There are many categories are there. That which category should form part of my core portfolio, should become as part of my permanent portfolio, and which part of the mutual fund multiple schemes that can be considered over and above that. Right? That's always the question mark which is there. I think as per our own analysis, the research that undertaken, the large component of the core portfolio is like any money manager constructs. But if I as a money manager, I have say 10,000 crores to money to manage, I always design a portfolio strategy in two parts. One is the core portfolio, and second is the satellite portfolio. Satellite is something I'll use it for differentiating on my portfolio return, and core is something I'll actually buy it for longer, buy and hold it, and keep it for long-term wealth creation. Assuming you have to draw a parallel of the same thing, same portfolio construction concept, but from an individual investor's point of view or HNI's point of view, he has to also apply the same principle. Investment doesn't change from person to person. Everybody is anyway manager of money. Therefore, how it can actually be made part of the core of the investors. In that context, when we were debating and discussing that, we must look at pro investing as a principle, given the fact that we have been doing the education initiatives across different topics like SAP, STP, or investing in equity, investing in debt. And within that category as an equity investing, then how that portfolio construction has to happen. That's why we came with the pro investing as a concept. But every investor who has money, first and foremost, the way he has to get onboarded, a balanced advantage fund is something, is an investor not been trying out much of in equity. At the same time, he wants to have the flavor of equity. At the same time, he's coming for the longer term. At the same time, money manager will of course take the call of moving in and out, depending upon what the market outlook is in terms of allocating exposure to equity, reducing exposure to equity, and so on and so forth. Therefore, first and foremost comes the balanced advantage fund. Then comes is actually the investing in blue chip, large cap, frontline companies, where they all have established track record, they all become large in size. The company will continue to become large in size given the fact they have become already large in the size and being part of the say BSE 100. So become large cap names. So I call it the frontline companies, you can call it the large cap, whichever you call it.
Whatever you call it, yes.
Whatever you call it. That could potentially become the second large component of growth portfolio allocation to happen. The third comes actually is one of the worry that one of the not worry or one of the thoughts that comes in everybody's mind. Sometimes we do get confused between investing in a which market cap company actually make investment. Sometimes we believe that mid cap could potentially run, and therefore I should have mid cap, and or maybe a large cap would do very well, therefore I should have large cap. So therefore, that's something you and me will not be able to find an answer as a common investor. The same, leave the choice to money managers such a flexi-cap fund. But in the flexi-cap fund, the money manager uses his own research capability, macro understanding that he has. At the same time, he also sees where the big money can be made vis-a-vis one certain segment of the market or market cap segment of the market, on basis which I think he actually allocates money into various segments of the market. Sometimes he go over, he's more skewed towards large cap. Sometimes we go more skewed towards mid cap. Sometimes we also go more skewed towards small cap in order to generate the optimum return over a period of time. That way, if you look at each of the concept from a risk category point of view, balance advantage fund and within the equity category, it comes the next is the lowest. Then comes is the large cap oriented funds, which is the frontline stocks in which you make investment. And third is actually the flexi cap. Therefore, this we believe that should form part of the core portfolio of every investors. Whether you make lump sum investment, or you make SIP investment, or you make STP investment by way of putting money in liquid fund or the debt funds, and then systematically you transfer, whichever way you actually make the investment choices. At the end of the day, for anyone to generate a longer term wealth and longer term fulfillment of your dream that everyone will make the investment, for which they have to make investment in equity. The question doesn't arise, which is the scheme in which you invest. And within the equity as a category, we believe that these different type of schemes should form part of the core portfolio construction of the investors. That's why we came with a concept called pro investing. At the end of the day, education at a broader level can be done and a continuous interval, there is no issues. Unless until we go and address the specific issues that the investors will have in their mind and help them actually take a better decision as informed decision by creating a deeper understanding of how the portfolio has to be constructed, we believe that will remain as a backbone. So actually, our Aditya mutual fund this year, the pro investing as a concept and educating investors, they came with this background.
Got it. I'll have specific 2 questions on the categories as well, but just before that, can I ask you, you reckon this will be a prudent strategy for investing, whether the trend of the market may be upwards going ahead or downwards going ahead as well? How would such a portfolio limit the downsides that come in during a bear market? Because a large portion of this set of portfolio funds that we build is still equity linked or equities per se.
Correct. I think interesting the way we are gone about choosing the entire category of schemes. As I mentioned, we have only chosen 3 categories. One is the balance advantage fund, which moves equity from a low of say 50% to as high as about 70%, depending upon the market multiples, valuations, and where the big money could be made. If you are not bullish on equity, then you run as lower exposure to equity. This is something takes care of the potential risks that are arising on account of the market volatility. Whereas the large cap oriented funds are the funds that invest in frontline companies, that takes care of the is like coming into the Sensex or Nifty and then staying invested for a long period despite all the volatilities. That takes care of your second large component of your allocations. At the same time, as I mentioned, the query that you may have, the market always, if you look at it, get divided. I think there are times where market favors only one segment of market cap of companies, and one segment of market cap companies get neglected. That's something again it is taken care to the flexi cap. Therefore, the risk associated with the market, whether to the fluctuations, whether to the trend change that we see happening, whether related to the valuations, all such things are taken care of this 3 components of the portfolio. Only the question which will remain still unanswered in this is how much is the allocation of money of investors. Let us assuming somebody put 10 lakh rupees. How much of the money should go between these 3 categories? And if this something will remain unanswered, but of course, I need to, of course, give some kind of sense. And given the fact that, as I mentioned, the risk spectrum, if I put the risk on a 1 to 10 scales, the risk of, say, balance advantage fund will come into the, say, 6 or 7. Because given the fact, 1 being the lowest risk and 10 being the highest risk, and balance fund categories come in the middle pack, and given the fact there's a good combination of equity fixed income. Let's say that becomes, say, 5 or 6. Then you have large cap oriented funds will come and say 7.5 or 8. And then the flexi cap will come in the say 8.5 or 9 or 10. That's the way I think the risk spectrum will work. Therefore, that itself will take care of your potential risk that you may be carrying on these allocations. At the same time, it also takes care of the potential missing out fear that one may have by having the responsibility lying with the fund manager to take that call.
Okay. And what percentage of the overall portfolio should be the core portfolio, Mr. Balasubramanian?
Roughly about 65 to 68% of your portfolio should be the core. The way I go my own longer term and principle of investing, at any portfolio in the case of equity or maybe any personal investments when you create, anywhere between 50 to 60% one makes investment in equity, and rest of it comes in various asset classes like fixed income and other things. If you have to draw a parallel of a similar concept within the core portfolio, as in the equity investing, 60 to 68% should be forming part of the core portfolio. Even today, if you look at the size of the industry, I think if you look at you have 20 lakh crores of size. Within that, you remove the ETF, right? ETF something is more of index-oriented funds. You knock that off. I mean, actively managed funds is roughly about 13.5 or 14 lakh crore. And within that, if you take almost about 60% of their assets and management within the active category would come from these three categories.
Got it. Now, just one final set of questions, Mr. Balasubramanian. One on flexi cap and one is on the large cap. Now, the SPIVA indicators or studies or otherwise show that, for example, pure large cap funds have not been able to outperform the index ETFs by a wide margin per se. There could be exceptions, but those would be exceptions to the rule as opposed to the standard. So would it pay to actually look at index ETFs, for example, or passive large cap products as opposed to actively manage frontline products? Would that be a strategy that could be pursued as well?
Now, while of course one cannot rule out that, I think while your observation is in some sense we can say right, but at the same time the ETF, which I've been having the belief that ETF should sit over and above the investment that you make in active managed funds, and it's a complementary, it's not a competition. And the very fact that one may notice today that the large cap oriented money managers, for that matter, every active managers would underperform the index, there's no doubt. At the end of the day, the index is driven by few stocks which have got a very large weightage in the index, and sometimes the index is driven by few sectors which have got a large dominance in the index in terms of creation weight. And one must also remember the fact that when such a large dominance, let us assuming, go out of favor, which does happen. I think these companies or maybe the sectors don't remain favorable all point of time, depending upon which market situation in which you operate. In such a scenario, what do you do? And then the rest of the market, they start performing. Even the money managers generally will have a tendency to outperform the market. Historically, I've seen that most of the large cap managers outperform the market not by buying only large cap names alone, or not by mapping the portfolio only to the index alone. His own ability to pick stocks which could be a performer better than the large market, that's why I think he tends to perform. And that's something in the last 2 years we know for sure that money managers have gone through a tough time, given the fact the markets are driven by few stocks and few sectors, and therefore money managers had their own constraints on one side. At the same time, during pandemic time, everyone market went through a different kind of cycles. But that's something generally is not seen as a permanent. These are generally the performance come back to normal. Therefore, from an investor's point of view, core can be fixed. Maybe instead of 65, you can put say 55. But the ETF should be forming part of in addition to the core portfolio. That's why I say, because I consider index investing, ETF investing as a complementary. And though index investing is actually lazy investing, no doubt, but sometimes lazy investing can form part of some portion of the portfolio, but not necessarily has to come at the cost of active allocation to active management.
Makes sense. The other question, and that one advisor was making on the show 2 or 3 shows back, Mr. Balasubramanian, is that the risk weightage of the risk adjusted returns or the risk weightage of a flexi cap fund is actually, the flexi cap fund is apparently more safer currently than a large cap fund. And most of the flexi cap funds have about 70, 75%, 80% exposure to large caps any which ways in the industry currently. So instead of buying a large cap fund, might as well buy a flexi cap fund because it's a lower risk and a slightly possibility of a higher return because of some presence of mid caps and small caps. So would you tinker around, or do you believe that because you're making an all-weather portfolio which could last 5, 10, 15 years, having both would be a necessity?
See, over a period of time, I think what makes the difference in fund management is the discipline that you bring in your portfolio construction. And if you take large cap oriented funds, definitely the discipline that being adopted by them, the 80% investment in large cap, 80-85%, rest 15% come from mid cap, or maybe rest of the market cap companies, brings certain amount of discipline. The large cap also has got discipline of investing in various sectors in relation to the sector weight in the index. Then that comes as a complete discipline. At the same time, flexi cap fund where the money manager, of course, decides which segment of the market in which you have to go. Therefore, that gives you a flavor of that moving across market cycles, across market cap, but left to the choice of the investors. Therefore, from the investor's point of view, I think you need to have funds as part of your portfolio, which are highly disciplined funds, which of course will not have any other glamour attached to you in the form of, okay, I'll move from here to there and so on and so forth. At the same time, you also have the balance advantage fund. Again, comes with the discipline of related to the valuation and so on and so forth. And flexi cap, of course, funds brings in the as you rightly mentioned, it comes a little bit of the higher risk category. At the same time, higher the risk, higher the return in the long term. Lower the risk, lower the return even in the long term, right? I think if you go with that principle, I think you're able to cover the entire risk spectrum on one side, and then you're also able to cover the entire discipline of investing, which money manager has to do, money manager has to follow. Also, it gets covered to give investors a larger comfort. Another thing, from an investor's point of view, the reason why we said that the three portfolio is very important, most of the times investors may keep debating, how should I go about investing in one fund, two funds, three funds, and so on and so forth. When the more you discuss about this, invariably you'll end up actually not choosing any, or you may end up choosing something which could become a sectoral fund, which will carry a more risk. That's why I call it as a core portfolio as a concept. Like when we as a money manager, when we buy actually the banks and the large cap banks, we don't buy only one large cap bank. We actually buy the leaders in the category. So there are 3 or 4 leaders in this category. So that's why I think the money manager will buy banking as a sector in his portfolio, knowing very well all the 3 stocks will perform more or less the same. But despite that, they will have all the 3 stocks will be part of the portfolio, given the fact that they're leaders in the industry. Therefore, the large cap fund brings in that as a category, and flexi cap fund will have a different kind of strategy. I think from an investor's point of view, I think cutting across different cycles, cutting across different discipline which money managers will follow, and then cutting across different risk each of the funds will carry. All the 3, I think, would be addressed with the creation of core portfolio. That's why we say that it's not either or one, it's about all. If somebody, of course, cannot afford to put money in all the 3 schemes, which of course nowhere it can happen, given the fact even a 10,000 rupees can be split between these 3 schemes to create a portfolio, to create a different experience. Also, one must keep in mind, no one fund performs in a linear fashion across all cycles. Every fund will go through different ups and downs. The way we are gone about choosing these 3 funds, the balance advantage fund will actually have least volatility compared to the broad market. Then comes the large cap, then comes actually the flex cap. So you're able to also cut across these schemes as part of the portfolio selection, cutting across different market cycles, different fluctuation. And therefore, we believe that it should form part of the core rather than 1 or 2.
Got it. And viewers, so for example, if you're convinced with this argument, Aditya Birla themselves have a frontline equity fund, a flexi cap fund, and a balanced advantage funds as well, the returns of which since inception or otherwise or a 3-year period have looked pretty healthy. So maybe this could work. One final question, a quick one before we wrap up, Mr. Balasubramanian. Has there been any kind of, I'm throwing this out of the blue at you, really, I don't know if you have an answer, but I'm asking you, has there been any kind of back testing done for a portfolio like this, and what kind of returns can it generate vis-a-vis, let's say, the benchmarks, and what kind of alpha or otherwise?
See, we are not doing any kind of back testing per se, but back testing is done only on the basis of how money has to be allocated into various categories, given the fact that you have to weather around market volatility. You always have this, again, the feedback that has come from various people. Okay, you are all saying equity is bullish. How do you go about investing in equity? This is a common question which comes. So all of us are very bullish on fixed income schemes and in the current juncture, but we do not know how to choose these funds. Therefore, we thought that will help in actually choosing the funds of the investors rather than selling the funds with a return. At the end of the day, return is not most important at this point of time deciding your allocations. I think what is most important actually that investment that I'm making for the longer term, how the investments have to be allocated into various categories within the equity, and within the equity, how I should come about creating core portfolio. The return is a function of market. And I think if I have to take longer term outlook, if you have to take as a 10-year, 15-year cycles, and believe me, the experience would be either in line with the market or it will be better than the market, given the fact that we'll have a mix of these portfolios, which takes into account the market volatility and so on and so forth, as I explained earlier.
Great. Mr. Balasubramanian, pleasure talking to you as always. Thank you so much for taking the time out and giving us some lovely insights. Hopefully, it helps investors in taking a good decision.
Thank you, Neeraj, and it's always my pleasure to be part of your show and advocating. You being one of the advocates of mutual industry, it's always a pleasure to be part of your show.
Thank you so much for being here, and viewers, thanks for tuning into this leg of the Mutual Fund Show.